Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Equity markets are recovering after indigestion took over through last week. The question of whether a slowing equity market can make it a stronger equity market is being asked. Perhaps this is a useful shift in the narrative away from zero-sum talk. Will the next few weeks of greater government data releases in the US and the annual dance, if you will, before a year-end Fed decision allow for markets to calmly march forward? Here to help us understand where a 5% drawdown in equity market lands us as we approach the final month of the year is Fidelity's Director of Global Macro, Jurrien Timmer. A delight to see you. We're seeing you from across the pond. Thank you for joining us, Jurrien.
Yes, thank you. I'm at my parents' house. We're here for the Thanksgiving holidays, and fingers crossed that the Wi-Fi holds up because it's sort of peak internet hours here at 5:30 in the afternoon. So.
Well, we're delighted to have you, and if it happens to go to audio or something like that, we will roll with it. That is absolutely fine. Yeah. We'll invite everyone to send questions in for Jurrien over the next little while. I was struck certainly by the discussion of what we saw last week, what we might be landing in this week. You've been pointing to some time that you're not so uncomfortable, actually, with a little bit of a pullback. That's what we've gotten.
Yes, I mean, it sounds a little backwards, but we've been looking at analogs to the internet bubble back 25 years ago, and will the AI boom become a bubble? The action in sort of the non-profitable tech, the other cats and dogs of companies that promise a lot of great things but don't really have earnings, or in some case even revenues to back it up. But it's sort of, trust me, we'll create something. A lot of those stocks, of course, went to the moon, and then we can pull up slide 8, and those stocks have been coming back down to earth. So again, we're looking at Bitcoin miners, which kind of became a hyperscaler theme, the meme stocks, non-profitable tech like nuclear names, anything that was even remotely related to anything AI. They've been coming down as investors have started to question sort of the circularity of what some of what we're seeing, the big providers of the picks and shovels, if you will, financing its buyers, even though those buyers don't necessarily have any customers for their product. And so it's sort of a build it and they will come. And of course, we've seen that before. Cisco did that back in the internet bubble days. So I think as we've seen some of these hyperscalers borrow a ton of money in the bond market in the last few days and weeks, I think the markets are sobering up a little bit, that some of the pie in the sky stuff that we're seeing really needs to be backed up. And, as painful it is for anyone who is in those stocks, I think it's actually very healthy. I mean, I don't want to be the one that says corrections are healthy, because they're always healthy until they actually happen to you. But I would rather have a shaking of the tree now, if you will, that kind of shakes out the weak-handed longs, the paper hands, as we call it in crypto, now than have it just be uninterrupted and ends up in a parabolic move later. Because I can tell you, bubbles, once they burst, we saw this in 2000, it leaves a lot of scar tissue behind. So I'd rather have an occasional reset on the way to a sustainable boom than having it all sort of end in tears now. And who knows, maybe we were never going to have a bubble, maybe we won't, maybe it's not even a boom. But I think that I would prefer this over the alternative.
Right. It's so fascinating. And in terms of liquidity coming out of the market, for instance, or shaking out some leverage, liquidity, those are all L words that go along with sort of bubbles and so on. What did we see there? I mean, is there sort of a calmer, less liquidity sloshing around? Just a little bit. I mean, we're not talking a ton here, but is that good too?
Yeah, so if we go to slide 1, so we can see the degree to which some of these more speculative corners of the market have come down. And I think part of it is year end. I mean, we're not at year end yet, but it's been a pretty momentous ride this year, right? I mean, we're still up double digits in the S&P, and that's despite a 21% decline in March and April. And again, I think investors are looking at the returns. They're looking at um, the uninterrupted course of this AI narrative and maybe wondering, okay, what is going to be the killer app at the end of the day that's going to pay for all of these hundreds of billions of capex spending? And I think these are all the right questions to ask, because I would rather have a 10-year boom than a 1-year bubble, right? I think
Right.
we all would. And so I think there's a number of factors going on, and of course the Fed is also in play. I think that's maybe a little bit overplayed. But and we'll talk about the Fed. But all of a sudden, that December rate cut that we all thought was a given is now anything but a given. And again, we'll talk about the Fed in a moment. But it's hard to believe that that's really a reason why all of this stuff all of a sudden is
Mm.
happening. But it was maybe icing on the cake for investors saying, you know what, it's been a hell of a ride. Maybe we could ride it all the way into Christmas, but why don't we take some chips off the table now? And I think part of it is that which is what's going on. And the question is obviously how much further it will go. I mean, we're down. S&P is down 5% from the high, which history shows is really mostly a nothing burger if that's where it stays. I mean, the market is down that much almost any time. Even a 10 to 15% correction is relatively common. It happens usually once a year. Of course, we've had one already this year. But if we go to slide 2, you look at the Mag 7, it's still kind of in that range. And again, it's been a meteoric ride since that April 8th low. And so, it can only go up so much at a time. And what one thing we're seeing actually is that even though we think it's just the speculative corners of the market or even the AI names, and of course we saw the Nvidia earnings release, which was gangbusters, but then that reversal. But it actually is happening under the surface as well. You can see in the bottom panel here that only a minority of stocks are now above their 50-day moving average. And it's not quite oversold enough to say, okay, wow, that probably is a bottom. So
That's
maybe
interesting.
we'll go back and forth a little bit further. And again, that's really not terrible. Again, if you look at that chart, or let's say go to slide 3, you look at the S&P cap weighted index, which is the one with the blue line, versus the equal weighted, which is the one with the purple line. Again, it's been quite a ride for the last, what is that, 7, 8 months.
Mhm.
And in a way, we're having reverse seasonals right now, because usually the summer is weak. You get a bottom in early October, and then you've got the Santa rally. And we've actually had a positive summer, and now we're having weakness in late November. But again, seasonals only work all else being equal, and certainly in 2025, nothing else is equal these days.
It's been a fascinating year. I'm fascinated to see how you and others will write the history books on this one. Um, you've mentioned, I think, before in some notes that within the discussion of is AI overdone, a piece of it is, does the world need AI to make us all much more productive, or else the debt is going to be an issue? That there's sort of a leap there, and I'd love you to bridge it for us,
Yeah.
if you don't mind.
Yeah. So there's a lot riding on the AI boom, right? I mean, not only the stocks in question, again, Nvidia at least was last week a $5 trillion company. The Mag 7 are almost 40% of the S&P. A lot of concentration risk, and that risk is great when it's going well, but it's not so great when it doesn't. So a lot in the stock market, at least the US stock market, is riding on the AI boom. Geopolitically, there's a lot riding because it is kind of like an arms race between the US and China. Both countries want to get to that dominance point, as fast as possible. But there's, like you said, there's a larger narrative as well, and that is that the world is being, or most of the developed world, is being strangled by an ever larger debt burden, right? Canada, the US, the UK, Europe, China, Japan. You have debt to GDP levels, including government, corporate, and household, that in many places is exceeding 300%. And with demographics aging, and I'm seeing it here in Holland, even with my own parents this week, where is the growth going to come from? Because the speed limit, the non-inflationary speed limit for the economy, is essentially growth in the labor force plus growth in productivity. And so we have aging populations in many places in the world. There's now a backlash against immigration, certainly in the US. Probably you have a little bit of that in Canada. In Europe, of course, with refugees, that's been at play as well. So if you're not going to naturally boost the speed limit by having just more people working, then you need to do it through immigration, through productivity. And of course, AI is the great promise on that, right? Because the way people are describing AI, at least the proponents of how it could work well, is that essentially the hyperscalers are like creating running water the way people did centuries ago, or like electricity or infrastructure. They're laying the pipes for a new economy to function on, and that new economy is beyond obviously Chat GPT. That only gets you so far, but really a whole new way of creating efficiencies in business. And so, if that does create a productivity boom, then that would be the great hope to lift that non-inflationary speed limit, because right now the speed limit is pretty low, which doesn't mean it can't go up, or that it can't be exceeded. But if it does, you create inflation. And so if you create the non-inflationary speed limit, then you have a lot more room to grow without the Fed or the Bank of Canada or other central banks raining on the parade, if you will. And then you can really grow your way out of debt, or at least keep pace with it. And so again, there's a lot riding on this, both at the micro, the macro, and like the super macro level. And again, I speak to my colleagues over here in Boston who are very involved in the AI space, but we don't really know how this cookie is going to crumble. We don't really know what the apps are going to be. But right now, they're laying the groundwork. It's the picks and shovels are creating the infrastructure, and it costs a lot of money because all of whatever it is that we're going to be doing, it's going to be very power hungry, and that requires electricity, which requires a lot of investment. And so you could have all the hopes being fulfilled, but at the same time, that doesn't mean that the companies that are building this system are actually going to reap the benefit, right? They may the depreciation schedule of all this capex may not be in line with when the promise comes to fruition. And so I think for the market, that's where we are right now in terms of trying to figure out what the end game is, even if everyone agrees that the end game for you and me and for society are going to be good.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connect's The Upside and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
You've done lots of work, Jurrien, on Bitcoin. We've seen Bitcoin slide. It's part of the market narrative, certainly from the last week. With everything that you're describing, and in terms of economies becoming much more productive, there's also the issuance of stable coins. All kinds of coins, of course, have been issued. But this idea that governments themselves, in terms of being able to control a central bank digital asset, either replacing their own dollars, shekels, whatever it is. But that will lead to faster processing of everything. There's a productivity in just sort of the transition of money. It leads to the financial sector, certainly. Can you just comment on that? I mean, we've seen central banks recently starting to announce the fact they're going down this road, some faster than others, but we're going down the road.
Yeah, and we had the Genius Act in the U.S. last year. I guess it was last year.
The summer,
that
yeah.
really, that really legitimizes stable coins. And of course, the angle from the Treasury Department, run by Scott Bessent, I think undoubtedly is like, if we can get a lot of stable coins out there, that means they all have to buy a lot of treasuries as the backup for the value. And it's interesting because the Genius Act forbids the stable coins from paying an interest rate. So for the stable coins themselves, and we saw like the Circle IPO was incredibly successful. These companies essentially have a license to mint money. If they can earn 4% by having treasury bills backing up their stable coins, and they're not allowed by law to pay interest on them, then that's a pretty lucrative deal. And my guess is that the stable coins obviously make the financial system run a lot smoother. They're disintermediating the banks. Like if I'm sending money to Holland or somewhere else, if you send that through Swift, like I think 3 or 4 different banks touch that, and of course there's an expense. So the promise with stable coins is that could become much more frictionless. But stable coins themselves, I don't think are going to be a store of value just because they don't pay interest, right? I mean, you're not going to trust a stable coin more than you would the treasury or bank deposits, which are of course insured, because those stable coins own the same bills that you could buy directly from the treasury or a money market fund and get actually a nice interest rate. So I don't think they're going to totally disrupt the system. They could steal some market share from banks just for convenience cash, where you're not really concerned about what kind of interest rates it yields. But certainly it's a game changer, and in a way, it extends the reach of the U.S. dollar. So in that sense, rather than kind of disrupting the dollar's reserve status, which is what Bitcoin and stablecoins were seen as doing a few years ago, I think if anything, they will further the reach of the U.S. dollar, which might mitigate some of the stories about fiscal dominance and what that does to the dollar. But you mentioned Bitcoin, slide 14. You can see Bitcoin has really had quite a run lower here. It peaked at 125,000 just in October, and we got to 80,000 last week. We're higher now. I think we're about 86,000. And the question is, why is that happening? I think there's a couple of reasons. Like ironically, maybe stable coins have slightly diminished the need for Bitcoin, because now you can
That's what I
have
was wondering.
electronic money.
Yeah. Mm-hmm.
Yeah. I mean, Bitcoin was never going to be a great medium of exchange just because it's too scarce, it's too volatile. And then there are some questions about what we call these Bitcoin treasury companies, like
Yes.
MicroStrategy, that really have not been buying as much, and obviously, and their stocks are actually quite down. So what we've been seeing is some whales, like these very big OG type of holders, essentially taking profits, which you can't argue with. I mean, they've been owning them since Bitcoin was a penny. But while they were doing that a few months ago, these treasury operations were taking that supply and adding it to their portfolio, and that's not happening right now. And of course, as we've said many times, Bitcoin is like Dr. Jekyll and Mr. Hyde. It can be boring gold one moment, and it can be the NASDAQ the next moment. And right now, you have the global money supply is robust, but it's not growing very fast. And at the same time, you have the stock market now wobbling, and these high momentum leverage plays wobbling as well. And Bitcoin is kind of like falling, in cahoots with those groups. So I think it's a correction. I don't think it's much more than that. Bitcoin is volatile, of course, we know that, but it's sort of getting caught up in the storm of the non-profitable tech. And actually, if we pull up slide 9, we can just pivot to that for a moment and just show you to what degree those have now sold off, right? So they more than doubled in the span of 8-9 months. And we're now getting back closer to support. So these are the non-profitable tech stocks. And the next chart, slide 10, are the meme stocks. These are thematic baskets from Goldman Sachs. And you can see how much closer we're getting. So that's slide 10, are the meme stocks that we are getting closer to that support line, which I think will probably hold.
Yeah, the next slide. We'll just take a quick look at that, if that's okay. But I'll ask you another question in between. the discussion of what is safe and the memories, I guess, of fixed income and equities going down the chute at the same time in 2022. It's a different story. There's some worries that that correlation is still there, but in fact, bonds are doing exactly what they're meant to do at this point, aren't they?
Yes, so we can go to slide 11. Frankly, I'm pleasantly surprised how well behaved the bond market has been this year, because you remember earlier, back in February, March, early
Yes.
April, when we had the tariff tantrum, the dollar was going down, treasury yields were going up. So the two best known safe havens, other than gold, were not being very safe. And that was really when the questions of fiscal dominance and will foreign investors continue to support our bond market were really, very prominent. And things have really quieted down. So the 10-year yield is around 4.10, 4.15, very, very quiet. The Fed has delivered two rate cuts. Even if they don't go in December, they are now fairly close into the neutral zone, that the Fed really should not be seen as a burden on the financial system. And of course, the Fed ended quantitative tightening as well. But what we're seeing with this 5% decline, and again, it's only 5%, right? It's sort of a rounding error in the grand scheme of things, but it's not caused by the bond market, which is a nice change, because really since 2022, most routes in the stock market were caused by rising yields, and that is not happening. So in the top part here, the top panel, I show the drawdown in the stock market, which is the orange line, the drawdown in the bond market, which is the gray line, and you can see the bond market is not in any kind of drawdown. So that shows you that the 60 and the 40 are currently not correlated.
Yeah.
And in the bottom panel, I show the 12-month correlation and the 5-year correlation. And you can see that back in 2019, stocks and bonds were steeply negatively correlated. And then by late 2022, they were steeply positively correlated. And right now, the 5-year correlation is positive, because it's, you're looking back 5 years, and that 2019 data has fallen off. So you have really just that positive period. But if you look at the 12-month correlation, it's slightly positive, but I would say bonds at this point have become an uncorrelated asset, and that's what we want to see, right? We want to have diversifiers in a portfolio, and if bonds are not going to be negatively correlated, at least they should be as uncorrelated as possible and not positively correlated. And right now, they are uncorrelated, and that means we can own bonds, get a positive real yield, and not worry that bonds and stocks necessarily are going to go down at the same time, which doesn't mean they won't in the future, but at least right now, they're providing some ballast here.
That's great. There's a couple of questions that are rolling in. One is just putting the number of options that expired last week into context and what that contributed possibly to last week's roiling volatility.
Yeah, so slide 6 actually shows the call put ratio. And you can see that has come way down. So the average of the call put ratios, the number of calls versus puts outstanding on the S&P, is about 1.25. It's not 1, just because generally the market goes up. So generally there are more calls out there than puts. And so we went from a ratio of like 1.7, 1.5 to now 1.17, which is not what we saw in April, where it was well below 1. But it shows that kind of that excess demand or excess froth, if you will, has quickly come down, which you would expect, of course, because again, some of these speculative names are way down from their highs. So you would expect to see this. And again, to me, this is again, it sounds harsh because a lot of people may have been playing in those names, but to me, this is like a palate cleanser, that if this really is a transformative boom that we're in, we don't want it to end anytime before it needs to, just because stocks were driven to unrealistic levels and then the bubble implodes. So I think this is, for the long term, this is a good thing. And as always, diversified long-term investors should take advantage of moments of volatility and rebalance, just as they should when the market goes up a lot or goes down a lot. So this is a good opportunity to sit down with your advisors. Well, you are advisors on this call, but to sit down with your clients and say, okay, where do you want to be? Where should you be? Where are you? Are you over your skis? Are you under your skis? And again, international stocks, I think, are a very nice way to play to diversify against concentration risk in the U.S., which of course has been somewhat top heavy.
Thank you. It's a great segue, as some people say, segue to ask you about share buybacks. Share buybacks in Europe have kind of traditionally not been there in Europe. I mean, they are more now. But this question of share buybacks, is there lots of room to do all kinds of share buybacks when you're dumping all your free cash flow and everything you got as a company into expanding CapEx for AI to make sure you're not left behind? Do you have money left to hoover up your shares?
Yeah. It's a great question, and definitely something that I'm wondering about. It's hard to find historical data to really explore that question, because buybacks were not really a thing back during the internet bubble, right? The buyback era kind of began in the mid 2000s,
Right. Okay.
and of course has been a very prominent feature for the U.S. market ever since. But you do wonder that if there's so much capex going on, I think the capex bill this year is like 600 billion just for these hyperscalers. I mean, gigantic numbers. Does that diminish the excess free cash flow, which will then impede their ability to buy back a lot of shares and essentially monetize their shareholders? And I think that's a very legitimate question. And maybe the shareholders, the investors look through that. But the math in the discounted cash flow model is pretty clear, right? You have dividends, you have buybacks. That's called the payout, and the payout ratio is the share of that payout versus earnings. And in the U.S., that payout ratio used to be almost like 90%. Now it's about 75%. Of which 2/3 is buybacks, 1/3 is dividends. In Europe and Japan, the payout ratio is now the same. It's very competitive, which is one reason I like Europe and Japan so much. The composition is different. It's 1/3 buybacks, 2/3 dividends. So to me, if the buyback story, it's not going to end, but if it goes down, that should, in theory, lower valuations for the companies who are engaged in them. At the same time that non-US stocks, especially developed stocks, are now much more competitive. Their payout is growing as much as the US, and the payout ratio is as high as in the US, but they're trading at 16 times earnings. The US is trading at 25 times earnings. So that, to me, could be another catalyst where the comparative advantage, if you will, of non-US stocks finally starts to take hold.
This is fascinating. Just as a final wrap up, you sort of gave us context about last week and where we go. What would you set us up for this week? Maybe longer than this week, but just sort of short term.
Yeah. I would just remind, so we'll go to slide 5. I would just remind everyone that, markets are volatile. They've gone up a lot, right? The market has doubled in 3 years, 3+ years. It has gone up almost tenfold since the secular bull market began. We're now talking about whether or not this is going to end in a bubble, and I'm not saying that we are, but even if you were convinced that it is, if you look at the analog in this chart of the current cycle and the period from 1998 to 2000, you can see how many large drawdowns there were of 10% or more on the way to new all-time highs. And again, I don't want to overplay this analog, but when the stakes are high and expectations are high and the valuations are high to match that, and we're a very long way into a very big bull market, like people are going to cash in their chips, and they may be wrong. And you're going to see periods like this where all of a sudden the market goes down for no reason. And it's a good time to kind of reassert, where are the fundamentals, where are the earnings, what am I willing to pay for those earnings through a PE, and what parts of the world provide a good a good hedge against a very concentrated US market.
Fascinating. We are so grateful for your time, Jurrien Timmer. Thank you for joining us. We wish your family very well during this week of Thanksgiving and just being together. Thank you for, we'll see you next week.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.